In this video, you are going to master how to use the moving average trading strategy. The moving average trading strategy is one of the strategies that so many traders are using to make money consistently in the forex market. And once you understand everything about this indicator, you'll be able to make money consistently in the forex market. Have it at the back of your mind that you cannot use the moving average alone. You have to combine it with price action, right? So always combine indicator with price action so as to get a high probability trading setup. A moving average is a technical indicator that helps investors, traders, to be able to trade the market, to be able to predict the future direction of the market. So if you truly want to understand the moving average strategy, you need to watch this video from the beginning to the end so as to get all the latest that you need about this strategy. Have it at the back of your mind that I'm going to share a live example with you guys so that you will understand how this strategy works. Moving average is a technical indicator that represents average closing currency pair in the market over a defined period. It indicates the market momentum and analyzes data through a series of currency pair. So we use the moving average to be able to dictate the directional movement of the market. And have it at the back of your mind that the moving average works extremely well during a trending market. That is why I said you need to combine it with what? Price action. Because during a ranging market, you're going to get so many whipsaw. But combining with price action, you will get a better entry and exit. So when we talk of the moving average, we have two major types of moving average. There are so many, but we have two major types. We have the exponential moving average and we have the simple moving average, right? So the difference between the two is that the exponential moving average add more weight to price data. It is more close to the price than the simple moving average. In other way around, the exponential moving average is used by short-term traders like day traders, right? But the simple moving average is used by long-term traders like position traders. So these are the difference between the simple and the exponential. So what do you want to use? For me, I would advise you to use the exponential moving average because of what it tells you what is happening currently in the market. It gives more weight to current data in the market compared to the simple moving average. So to trade profitably with the moving average strategy, there are two things you need to understand. One is the bounce and the second one is the crossover. So when we talk of the bounce, during a trending market, the price normally makes a pullback, right? And whenever the price comes to the moving average, it gets rejected. In other way around, the moving average is now acting as what? A support and resistance level. So that is why we call it the bounce. Whenever price comes to the moving average, it gets rejected during a trending market. If the market is in an uptrend, whenever price make a retracement to the moving average, it gets rejected and the uptrend continues. And if the market is in a downtrend, whenever the price makes a retracement to the moving average, it gets rejected and the downtrend continues. So in this scenario, the moving average is now working as what? As a dynamic support and resistance level. So we use the moving average as a dynamic support and resistance level during a trending market. It can be an uptrend and what? A downtrend. But have it at the back of your mind that during a ranging market, the moving average work nothing. It doesn't work at all because at that period, the market is flat. The market has no direction. And because of that, the moving average will be going up and down consistently. And if you trade blindly using the moving average, you will get so many whipsaw and this might end up blowing your account. So that is why, like I said, you need to combine it with price action. So you need a trend line to tell you that the price is actually in a trend, right? As long as the price is above the trend line, you can try the moving average consistently, right? So The same thing with ranging market. You can use the horizontal line to map the lows and the highs for you to know that the market is in a range. So once you add price action to the moving average strategy, it will give you a best sniper entry. It will give you more confidence, and it will help to project the directional movement of the market. So it is not wise to trade the moving average alone, but combining it with price action. So the second one is the breakout. In other words, we call it the crossover. So this one is when there is a crossover, you take an action. So crossover determines the changes in direction of trend. Whenever a crossover happens, it tells the investors or the traders that there is a change in trend. If the market was trending up and then the price now crossed below the moving average, it tells you that the trend have changed from up to down. We also have two moving average, like the faster moving average and the slower moving average, where we watch for crossover. If the faster moving average crosses above the slower moving average, it means an uptrend has begun. And if the faster moving average crosses below the slow moving average, it means the downtrend has begun. Another way that traders use the moving average strategy is whenever price is above the moving average, they look to buy only. And whenever price is below the moving average, they look to sell only. And there are several periods or kinds of moving average that you can use. We have the 10 moving average, we have the 20 moving average, we have the 50 moving average, we have the 100, and we have the 200. Each determines the type of trend. If the market is in a strong trend, you can use the 10 and the 20 EMA if the market is in a strong trend. But if the market is in a healthy trend, you can use the 50 EMA. But if the market is in a weak trend, then you can use the 200 or the 100 EMA. Because when the market is in a weak trend, it has a deep pullback. But when the market is in a healthy trend, it makes a retracement. That is when you get higher high and higher low, lower high and lower low. But when the market is in a strong trend, there hardly any deep pullback. Rather, the price can only pull back to the 20 EMA and continue in its direction. So these are the basic things you need to understand about the moving average. So once you have understood this, the bounce and the breakout, then we are going to dive straight into the live chart, and I will show you an example on how you can plot the moving average on your chart and trade it profitably. Alright, so we are on live chart, and this is gold SAUSD. So right now I'm going to show you how you can be able to make use of the moving average strategy. Before that, let me remove these levels. Okay, so for you to trade profitably using this strategy, the first thing you need to do is to go to the indicator, you click on it, then you search for moving average exponential. This is it. You click on it twice and it will bring out two. So this is it, the first and the second. For the fact that I hid it, let me make it visible. All right, so now you have been able to plot out the two moving average. Have it at the back of your mind that you can use one or you can use two. It depends on the style that you want. You can use two moving average or you can use one moving average. For this example, I'm using two moving average. So we have the faster moving average, which is this blue line, and the slower moving average, which is this black line. So you can go to the settings and make the settings that you want. Go to the settings. This is the settings, right? The input, you can put the length, which is 3 EMA. Then you can make it EMA, that is exponential moving average, then 3 EMA, and then you click save. Then, or you can come to style and enlarge the thickness of the line so that it can be more visible. After that, you can now click save. Then it will appear. Then the second one, you go back to the second one, you make the changes to the input. You can put 30 depending on the moving average you want, the period that you want. The length will be 30, the method will EMA, and the length will also be 30. Then you come to the style, and then you increase the thickness, and after that you click OK, and then the moving average is already plotted on the chart for you. So now the moving average has been plotted on the chart. We can now use it to trade alongside with what? Price action. And like I said, you don't have to trade it alone, you need to combine it with price action. So now that the market is in a trend, you can use a trend line alongside with the moving average, because like I said, there are so many trends in the market. We have the strong trend, the healthy trend, and the weak trend. Like I said, if the market is in a strong trend, the price will respect the 20 EMA. If the market is in a healthy trend, the price will respect the 50 EMA. But if the market is in a weak trend, the price will respect the 200 EMA, right? But you still need a trend line, because the trend line will help you to know the directional movement of the market, right? Just like I said, you need to include price action, right? So you use the trend line. So now if you watch, is that each time price crosses below the moving average, a downtrend continues, and each time price crosses above the moving average, an uptrend continues, right? And then this is what I'll talk about, the bounce. Here the moving average is acting as a support level, because each time price comes to the moving average, it gets rejected, telling you that the moving average is now acting as what? As a support level. And right now the price has broken below the moving average, and this is where the breakout takes place. So for the fact that the price has broken below the moving average, this is called a crossover. So in this scenario, you are expected to sell, just like normal support and resistance. When a resistance level is broken, buyers take control. When a support level is broken, sellers take control. Just the same thing that the moving average is acting. So you need to identify a trending market before you can use the moving average, right? So if you watch here, is that once the price crosses below the moving average, a downtrend begins. You can see the price rally down, and here the price crossed above the moving average again, an uptrend began, and the price rallied up. So here you can see that the moving average is acting as what? As a dynamic support, because each time price comes to the moving average, it gets rejected. Each time price comes to the moving average, it gets rejected. Each time price comes to the moving average, it gets rejected until the price breaks below the moving average. That tells you a change of trend. So that is what we mean by the bounce and the breakout. Let me give you an example again. You can see the crossover. Each time price crosses below the moving average, a downtrend begins, and each time price crosses above the moving average, an uptrend begins. So the moving average can also be used to trade as a breakout. In other words, you can use it as crossover. Whenever there's a crossover, you take action. So when the price and the faster moving average crosses below the slower moving average, you take what? A sell trade. And whenever price and the faster moving average crosses above the slower moving average, you take a buy trade. So this is it, but always include it with price action, because when the market begins to range, the price might cross above and below the moving average consistently. So that is when you need your trend line or your horizontal line to mark at levels. Like for instance, here you can simply use your trend line to connect the lows, because in this scenario you can clearly see that the price is not respecting the moving average. It goes down, comes up, goes down, comes up before it finally broke. So in this scenario, you use a trend line. So the trend line will help you. Each time the price comes to the trend line, you take a buy trade. Each time price comes to the trend line, you take a buy trade, because in this scenario the price is not respecting the moving average. So this is where I can say the price is respecting the moving average here, because each time the price makes a pullback to the moving average, it gets rejected. Each time price makes a pullback to the moving average, it gets rejected. So you need to understand the market condition before you take a trade. Don't trade the moving average strategy blindly. Like I say, you need to combine it with price action, right? You need a trend line and a horizontal line, so that if the price is not reacting to the moving average, you can use a trend line as a backup.